Well, everybody, we just witnessed one of the biggest comebacks since the 2008 financial crisis. And in today's video, we're discussing stock, crypto, and commodities markets. Was that a dead cat bounce or part of a bigger relief rally? We've got some information that'll interest you. See you soon, everyone. The best place for us to start today's video for the market recap of the 24th of January 2022 is the stock market and the large caps. Remember, all markets are connected, so you do need to understand what was going on here because it was a big deal. And on the surface of it, if you looked at these heat maps, you would think, hey, looks like a normal day. Bit of green, bit of red. But when we go over to the indices up until lunchtime in the session, you will notice it was a brutal sell-off. The Nasdaq went down as much as 5%. The S&P 500 slightly went under our key support and then fully rebounded into the end of the day. So this shows us a few important things. Firstly, buying into the close. Secondly, incredible volatility, which is symptomatic of repricing and usually some form of temporary base being found. But think about it. We had 6 days of selling off. Then all of a sudden we have buying into the close. It's a big deal. And we know that Wall Street likes to play the close and retail likes to play the open as much as possible. Let's move over to the sectors. Which ones were performing well? Turns out it was pretty much all in the growth stocks by the end of the day. It wasn't at the beginning, but by the end, we had things like semiconductors doing incredibly well. TAN, the solar index, switched from being down as much as 7% to up 1%. That's an 8% switch. And some hyper stocks were moving as much as 20% on the session. It's phenomenal how big these moves really were. And there's a whole bunch of reasons for this, but one of the big ones is we are in uncertainty ahead of the Federal Reserve on Wednesday coming out. We'll talk about that a little bit later, but also earnings week. This is the biggest earnings week. We've got Microsoft after the close, Tesla after the close on Wednesday, and then of course the big one, the biggest stock in the market, Apple after the close Thursday. If they're not able to perform, we could be in for further selling. I mean, it does come down to, at the end of the day, fundamentals in the market when we're looking at these types of things. And of course, Fed's support of the market. These are two very important factors. But what really is going on overall? Are we worried about rate hikes still? Is this even to do with rate hikes? We haven't even seen one yet the market's down as upwards of 20% here on the Nasdaq in some places. Just remember, let's keep a broader picture of what traditionally goes on around these times. Yes, markets don't like interest rate hikes, but overall they've still increased on the next 12 months after a rate hike has occurred. We also know that we're in a year of midterms, a year of potential weakness. Some of the weaker months or the weaker years in the market have been during midterm years, 2018, 2014, 2010, some big sell-offs, uncharacteristic sell-offs sometimes, but great returns the year later. Something to also keep in the back of your mind if you're an investor or someone looking at potentially buying positions for the longer term. We know Jan to March is volatile. We also know that we tend to get that stabilization through the middle of the year. So the first quarter could continue to be incredibly volatile. And we also know that technology suffers at the start of the year. If you were to go with the worst times to own technology, it's always been that January, February period. And then that March into the back end, into April, May, have been fantastic times to own technology. And remember, this is seasonality. It's something that's very important. But I want to discuss something a little bit different to the technical analysis here on the channel. I just want to go through the weightings here of some of the large companies in the S&P 500. So we all know that Apple makes up 6.8% of the entire S&P 500. Microsoft, 6% almost. Then we've got Amazon, Alphabet, which is Google, and Meta Platforms. Some of these big tech stocks really make up huge components of this market. So when we're talking about, is the market overvalued? Does the market deserve to be here? Realistically, we should be looking at the valuations a little bit on some of these stocks, and many people will call them ridiculous. But I want to just bring up a few of these and discuss them. Here we have Google, Alphabet, and what you'll notice is that growth has happened during the pandemic. Obviously, we saw Google, YouTube here where you're watching the video just perform amazingly over that time. And realistically, has the valuation of the company, the PE ratio, gone up? Not really. I mean, the price has gone up, but the growth is also there to justify this PE ratio over the history of Alphabet or Google stock price. Okay, cool. Exhibit 1, maybe not as overpriced as you think, especially at current rates. Then we move over to something like Microsoft here. Again, huge earnings, great subscription, huge moat, really great company. We all know that. And it has gone into almost a growth style, hyper growth cycle with such great growth since the pandemic. But the PE ratio, while it is high, is not completely out of this world on history of where Microsoft has been, especially since its breakout 16-17 earnings. Again, exhibit of maybe not as overpriced as we think. And this is a big stock that will move around the market. Facebook, another one that has performed well on earnings per share, but again, price-wise on the PE ratio has actually come down in terms of share value. In some ways, we would think this stock maybe isn't as overpriced as people believe. So this is just a case-by-case scenario of some of these large stocks. But if you're looking at it on face value, because these make up well over 20% of the market, again, Amazon dropping EPS, but still stagnating from the price that was formed here really in June of 2020, these show us that while the market maybe deserved to come back down, maybe it has formed a more fair price in terms of the PE ratios. The probably one big outlier from that is Apple. Great growth, but higher PE multiples than we've seen in some time. So is it really the fundamentals that are crashing the market here or forming them to come down? This is only a really brief look, and of course you can go into it more than this, but from a brief standpoint, some of these large companies may be not as expensive as possibly many people would make it out to believe. And therefore, should we really be worried about a market where a huge component of the indices is actually still earning huge money and at this stage looking like growth? Remember, we haven't had bad earnings yet, but we are in the week of that volatility. Let's move over to the VIX. So let's discuss the volatility. And this is where the bottom could be in from many different reasons. The VIX has spiked and fully reversed that fear. Something that is common with the VIX when we kind of seem to find some form of base. If you've been watching the VIX for a long time, it can spike and then very quickly short off and come right back down, then everything stabilizes. So the volatility or the VIX may have just found its high for now ahead of the Fed. Let's move over here to the 2-year yields. Now everyone's freaking out about inflation, but actually in the last couple of trading session days, remember this is the last 3 or 4 days, interest rates, according to the 2-year, are coming down. We're seeing 0.971 here as a reading on the 2-year. And if we go over to the 10-year, it's come back down to 1.776 from a high of 1.9. So is the market really falling on interest rate concerns, on inflation concerns, or is it just flushing out people? And it's done a very good job probably over the last session of doing so, freaking people out into some form of fear, FUD, getting scared and getting out of their market with their longer term positions. It could be doing so, because when we think about this US 10-year, this is not the kind of exponential movement just yet that we expect to see with a crash like we've just seen on the markets. Another big warning sign could be also the amount of puts that have been opened into the market. We bought this in our previous video where we're talking about bear trap. And at this stage, of course, we do expect a sideways market, possibly even a new low over the next couple of months. It's very possible. But when we get huge amounts of puts entered into the market hates paying them off. And we call them put walls. So we'll take a look at that for the SPY a little bit later, because we do have quite a lot of expirations coming in here into the end of the week with huge amounts of negative plays being put into the market. Puts ratio was as high as 1.3. And this just shows the amount of people entering into negative positions in comparison to positive positions. Let's look at some of the commodities markets. Gold is something we've looked at here for quite some time as a community. Resistances at that 1830 becoming a new level of support, a conservative support. Once we broke through, we thought this level would hold, and gold coming into the announcement by the Fed is looking relatively strong. Can we move towards 1870 though? Oh, I hope so. It certainly looks like it's possible. If we go down to something like a 1 hour, things are getting pretty juicy here. We've got the resistances of the last couple of rallies being literally tested as of the time of this recording. So we'll find out whether we can get the close above there. And next stop, you would have to think if the bulls gain control is around that 1870 level. Silver, a little bit weaker, but gold overall still looking fairly good. Let's get into the stocks before we begin the indices and the crypto discussion. And well done, community. Wow, your community trend line did very well, everybody. Look at this. I mean, can it get any more beautiful on Tesla ahead of earnings in terms of the support that was reached? If you had this trend line in and you were waiting for it, even if you're waiting for 900, you did okay. But imagine if you had this trend line in and you bought that level thinking, this is where I'm going to buy Tesla. We've had this line for a while now. We've talked about it. Does it get any better than that? Yeah, I'm zooming it in because it is so close to price. 851.50-ish or something on the low. 851.47 is the official low. And the trend line was sitting around 853.81. So incredibly close to the perfect level here for Tesla in the buy for the session. Well done to everybody. And as we know, that's a buy hammer or a bullish hammer. Now it's coming into earnings. Anything can happen into that, but at least it's held above the $900. And this is what we always expected. Some form of support ahead of earnings to be found, and then earnings to do the work on a stock like Tesla. Really, there's no real more technical analysis that you can do other than maybe if you make a new high in the next session, it continues to rally and possibly goes up to 1,000, because in only a few days, we will find out really the fundamentals, and fundamentals will trump the technicals in this aspect. If you breach underneath after the fundamentals, of course, really Tesla could be in for some serious crash fears. But if the technicals and the fundamentals end up holding up and we continue to hold support, then we can go on to trading as we usually do with Tesla. So well done to anyone that's picked it up if they were looking at a short kind of nimble and fast movement, because the VIX was above, and what a fantastic level. Let's move over to Apple. So Apple got down to around 155. We were hoping for it to get to around 153, 152. It didn't quite get there, but it did bounce up. And this is the story of the day. Bullish hammers across the board. Huge reversals on the session, but no current follow through in the markets. So could the market get up to 167, find resistance, and then bounce back down? That's what we call like a dead cat bounce. Effectively, it's a market where it looks like it's relief rallying, hits a point, and Apple is a great example of this, and then sells off. And I think we've got to be very, very careful of thinking that we're in a full-on V-shaped recovery. We asked our community today, you guys voted on this, and you came back with you did not think it was going to be a V-shaped rally. 75% of you thought it wasn't going to be a V-shape. And for anyone that doesn't know what a V-shaped rally is, it's basically what we saw since the pandemic. A full-on V. Most people think it's going to be something like this. Some form of max pain in the future, followed by a rally, and of course, a resurgence in the markets. So be careful about this. This is highly volatile. It's what we tend to see during repricing and these kind of uncertainty events, and rallies may be met by swift sellers. So somewhere around that 167, I'm sure day traders will be looking at the 20 and the 50 around there, should Apple be able to reach it. And for now, it's all about the small time frames on this stock. We'll move over to Microsoft as it's coming out with a big announcement in the next session. Of course, earnings coming through here. It turns out that trend line held, though it went much lower than that before it rallied back up. Again, no follow through yet because we haven't seen another session, but it all comes down to earnings here on Microsoft. And coming into earnings, if you were looking at this purely from a technical standpoint, you'd think, oh, it's on support. If I believe, whatever I believe about the fundamentals, if it holds, it could be a really great opportunity. So we'll find out more about that very, very soon. Let's move over to the specter in the room, or at least what I call IWM at the moment. It is the Wyckoff distribution that is very clear. I mean, this is a Wyckoff distribution. If you're not aware of what that is, probably should put that in Google and understand. We got our max pain, and they're very rarely wrong. And what this is telling us is that the market actually could continue to weaken because it's really a very well thought out pattern that took actually 12 months to form. Now, the Fed will rate rise. I mean, we know that. And how many, we don't know yet. And there will be some kind of uncertainty or instability around there. So the reason why there could be a dead cat bounce here is because let's think about if the IWM rallied. So it continues to rally and it hits something like this previous support. Do we expect sellers to be there? A 20 moving average on the daily, this red line here. It's going to be an area of interest and certainly an area where sellers could come back in and gain control and push the market back down to maybe an eventuation of 185 or 180 on IWM, the Russell 2000. So I think we're not out of the woods yet in terms of buyers coming back in. Everyone's probably feeling the FOMO, and these incredible volatility spikes are symptomatic of uncertainty and symptomatic of huge movements that can be kind of trappy. So we need to be careful, we need to be nimble, and remember, if you're investing, you're doing it on your medium to longer term literal opinion on the market, not necessarily the short term here. Let's move over to the major indices though. Nasdaq coming off 14,000. We had a suspicion that this might occur based on our S&P 500 analysis that we'll look at soon, and it went as low as 13,735. Now, if you ask me, do I think it's going there immediately on Monday? Look, my answer would be, probably not. I think it will find support around 14,000. And it did, but it did end up going a little bit lower. This is one of those things where when you see these long wicks, no doubt this is hit margin. So it's basically created that huge component of fear in the markets, and it's probably hit a lot of people's stop losses. A lot of people would have these psychological levels like 14,000 as buys with tight stop losses, get hit, and then it fully reverses. From the signals for the next couple of sessions, you'd be looking at relief rally to make a new peak, and then of course move up, and you wouldn't think you could get past the daily 200 moving average. This is the SMA, and this is the green line here. Any rally into something like a 14,800 or a 15,000, you would think would be met by swift selling, or at least some kind of seller to come back in. And the Fed will give us more clarity here. This really is a week where we must wait for a little bit of that information. We've hit our key supports that we thought may happen. Now it becomes a case of the fundamentals and the news linking to give us more clarity on the next couple of trades. One I would mention though is that when we start to see these huge volatility, and we'll do this in the S&P 500, we do get quite a few very similar phenomenon. So let's move over to the S&P 500 here and discuss it. Bullish hammer all day long from the action that we saw. No follow through in the next session yet, and we probably expect some sell-off first to occur in these markets after such a huge relief rally. If you were a day trader and you got the bottom, wouldn't you be thinking about taking the profit? And that's something that's a very interesting phenomenon. Think about some of these relief rallies we've seen in the past. This left-hand side shows us the story. Big rally, ends up selling back down to the low, then rallies again. Big rally, ends up selling down to the low, makes new lows, and then becomes bullish. Very common that these don't come back. I mean, very common they do come back and they don't continue on as much as you would think. That's why they call them the dead cat bounce. They're relief rallies, they look good, they get you in the FOMO, and then they trap you back into the next level. So 4,300 was definitely hit. This was a zone, the 50 exponential moving average, 4,300. We thought that psychological would hold up. It did, but it went a little bit lower. It ended up tapping the S3 and even a little bit lower than that on the monthly pivots. And we love using monthly pivots to find extreme zones. S3 pivot, hard to break this month. Obviously, we'll get new February ones coming forward. Definitely subscribe if you're interested in that, because that will be key. Let's go through some history though. We just saw some big rallies being met by sell-offs back into the low, but let's go back over to some of the other times that this has occurred back in history. And you'll notice that we often do see very similar things. Big relief rally, no follow through, stuffs around for a few weeks, hits the base again, and then that created the low. Similar over here. And in general, that's what you tend to see. Sometimes it follows through, and I think you can't ignore that. But a lot of the time, it does end up coming back for a second test. And if we believe in the seasonality of the Nasdaq having weakness in February, we believe in the Fed giving some clarity, but then the market still to be freaking out a little bit and figuring out to a degree how many interest rates are going to be there, there could be another retest of the lows. So yes, looks good on principle, but we haven't necessarily seen the lows printed just yet. Just the short-term lows ahead of the Fed. Something that I think we should all be watching. Now, one of the reasons that we think it's short-term lows, if you look here on the SPY, 430 was where it was reached, and of course it went down to 421. But let's look at the puts here and the calls. Look at this. All of a sudden, it went from being hugely positive calls in the previous weeks to puts everywhere. There's puts at 400 strike. There's puts at the 420 strike from the previous session. And there's put walls sitting all over the 430. So it makes sense for the market to try to close within this 460 to 430 area to make maximum profit from all of the options that have been opened over the last week. This is a big deal. This is exactly where you hope the market is find base. So we've got a very key support, very big rally, and at the same time, a huge amount of options that have been opened at that level. Interesting. Certainly adds to our speculation that maybe we have just found the low for this week. And again, around the right zone that we should have been finding it. Let's move over to the crypto market here. We'll quickly discuss Bitcoin. Like the Nasdaq, it seems to be running kind of with that a little bit. Huge sell-off followed by big relief rally on the Bitcoin, and it had a lot of volume behind it as well. Huge amount of trade going through all the networks. It hasn't quite given us enough confirmation that we're feeling positive about this. Again, it could be more of a fake thing, but when you get through these kind of highs like this 36,500 zone, you're finally saying, all right, we've put a bit of a base in. Maybe that was a max pain level, and we've trying to close above the resistance. And that's a fairly big deal. If you believed in those types of things where the market does come back and find kind of like a new fake out zone and then fully reverse, then you'd be feeling pretty confident about Bitcoin. And your next level of resistance, if you are bullish here, would be about 40,000 to 40,700 previous support over on the left-hand side. It's going to be hard to figure out whether this is exactly crypto's base because of its connection at the moment to the Nasdaq and the rest of the markets. But it certainly was a great rally, and we saw it across Bitcoin, Ethereum, and we also saw BTC shorts, one of the big indicators of what the whales are doing, start to decline for the second day. So this could be showing that the bottom is in for crypto for now, and that we've got some form of support here, and that we should see consolidation, if not a little bit of buying. So just a quick bit of information. Please remember that the FOMC statement is coming out 2 p.m. on the Wednesday session, New York time, and the FOMC press conference is half an hour after that. This bit of news is huge. It isn't always huge, but the market does seem to care about it at this point because we need to get some clarity from what the Fed is going to do in light of effectively the taper tantrum that we've seen in the markets. We've also got those massive earnings results, so keep a lookout for those and see whether these stocks continue to show outperformance like we've shown today. And if they do, maybe it's not as bad as we think. Remember to subscribe, smash that like button. We'll see you in the next one. Bye for now.